Welcome back to The Truth About the Market, where we cut through the noise and talk about what's really happening in aviation. Not the hype, not the headlines, but the truth. I'm Jason Zilberbrand, president of VREF. I've praised just about everything from Cessnas to Gulfstreams for clients that range from the FAA and SpaceX to celebrities and Fortune 50 companies, as well as fleets you've definitely heard of. And most importantly, I've owned and sold and operated my own aircraft. And equally important, this podcast is sponsor-free. No commercial paid-for opinions, no spins, just the unfiltered truth. And today, we're diving into one of the strangest aviation markets we've seen in years. We're deep into the fourth quarter of 2025, and the numbers are telling a story that doesn't behave the way markets usually do. We're slowing down and speeding up at the same time. Fewer aircraft are selling overall, but the ones that are, well, they're selling and moving faster than they have in years. If you want to understand what's actually happening in aviation today, not the noise, not the hype, this episode is for you. So let's get into it. If you've been around aviation long enough, you know that every year is a theme. Sometimes it's growth, sometimes it's contraction, but this year is about separation. A bifurcation between good airplanes and everything else. A split between the buyers who are ready and the ones who are still waiting for 2021 pricing to magically return, and a split between sellers who understand today's environment and those who still think their aircraft is the last one on Earth. This is a reorganizing market, a sorting market, and today we're going to explore every part of it. Retail transactions dropped from 15,986 in 2024 to 13,212 year to date for 2025. That's a 17% decline. It puts us right back to 2020 levels. But here's where things get interesting. A drop in transactions, it doesn't automatically mean that demand has collapsed. It just often means the rules have changed. Buyers are cautious and financing friction is still very, very real. And sellers are holding on to their aircraft longer. And the COVID-era urgency, that feeling of buy anything that isn't tied down, well, that's dead. It's long dead. But a slowing transaction count isn't the full story. Because the market didn't just pull back. It sharpened. It focused, and it got disciplined. This is the part nobody expected. Even though total sales are down, the days on market have collapsed for top-tier aircraft. Challenger 350s dropped from 105 days to just 49. Global 6000s went from 97 to 67. The G550, it went from 130 to 68. These are huge reductions. Why? Well, because the new long-range market is red hot. With fewer aircraft being made and even fewer being offered to non-fleet operators, there doesn't seem to be a cooling coming anytime soon. And secondly, because buyers are selective. They're ignoring aircraft with damage, missing records, deferred maintenance, outdated avionics, massive expensive upcoming airframe checks. Those airplanes sit. But good airplanes, turnkey aircraft with pedigree, they're gone instantly. And that, folks, is the G550 market. In August, you were able to pick from 50-plus aircraft, and today you won't find one. So let's talk about some of the slower movers and how they improved. Let's talk about the Hawker 400 XPR. It went from 303 days to sell an airplane to under 60. The ACJ market went from well over 300 days to about 100. 601s, all variants. It went from 300 days to well under 100. And G4s, an aircraft that had seen better times, went from 300 days on market to about 90. But don't be fooled. These weren't averages. And these aren't examples of averages. The aircraft that are selling are exceptional units. In today's market condition is everything, and undesirable aircraft are still undesirable, and those aircraft are still sitting. The 2024's worst performers took 240 to 300 days to sell. This year's slowest models perform better across the board. Older fleets with higher direct operating costs and limited support still sell, but usually in cash transactions or owner finance deals. And the contrast is clear. Good aircraft sell quick. Bad ones, well, they require a lot of creativity and marketing. But inventory is the backbone of any valuation cycle, and this year it tightened dramatically. Total listings are way down. We're down from about 5,089 in 2024 to 4,090 in 2025. Business jet listings, they fell from 19,541 to 8,300. And removals, they also dropped substantially. Aircraft removed from market in 2024 compared to 2025 dropped by almost 500 planes. So this is what a tightening looks like, right? Fewer listings, fewer aircraft being removed from the market, fewer choices. Owners are holding, and historically, when inventory drops and rates fall, retail activity snaps back fast. And folks, that's going to be the setup for 2026. This episode is brought to you by VREF, the trusted name in aircraft valuations and appraisals. Whether you fly a piston single or manage a business jet fleet, VREF keeps you grounded in data that matters. Visit VREF.com to know what your aircraft is really worth before you buy, sell, or finance. So let's talk about the split of the markets. And this is the part, that buyers and sellers, they feel directly. And I'm going to talk a little bit about where values are, and we're going to go through, the mixed bag of piston aircraft versus business jets. But overall, the business jet market was actually up slightly, about 3%. And so we're going to call that a flat market, certainly compared to the commercial aircraft sector, which is way down, double digits, 23%. And the helicopter market, that hung in there as well. So it's a flat market. It's only down about 1.2% overall year to year. Piston aircraft, total mixed bag. Modern high-performance aircraft are depreciating, and the older tried and true airframes continue to go up in value. But, age tells a real story for business jets, because if an aircraft is new to 5 years or of age, or still under what we call warranty period, it's actually up 12%, whereas aircraft just coming out of warranty up until that 10-year mark are down almost 13%. And then 10-year or older aircraft, those values are down about 2%. And this is the cleanest separation that we've seen in years, because new aircraft, they're continuing to rise because supply is very thin and financing is improving. And the middle-aged models correct downward because the 2021 to 2023 values were so inflated. Whereas the older aircraft, they remain stable, but that really depends on the operator and the ability to service the equipment, because keep in mind, older aircraft are getting very expensive to keep flying. So, that's the most important trend of the year. And speaking of trends, let's talk about off-market activity, because despite what we always say, and despite how off-market aircraft typically, those deals don't go very well, we've seen a surge in off-market activity compared to last year. Almost every long-range transaction I've reviewed in the last 6 months was an off-market deal. The higher quality aircraft, especially the low-time units, they're not hitting the public market at all. And a lot of people want to know why. And it's because of privacy, and it's because of exclusivity. A lot of the times in these newer aircraft deals that are still pre-owned, the OEM is involved. And a lot of the buyers, they're looking for immediate closings. And so they're doing very limited pre-buys. They're avoiding bidding wars. So it comes down to corporate discretion and speed, because while these are notable buyers, they're notable business buyers for the most part. They're not individuals or high net worth individuals, and they're not buying these aircraft for vanity flights to the Bahamas. They're really using them for business purposes. Private networks now drive the majority of premium aircraft sales. So let's talk about the most traded aircraft of 2025, because the rankings stayed very, very consistent from last year. The Robinson R44 and R66, they continue to dominate the entire market. There were more of those made than anything else. The Airbus H125, it remains right behind it. It's a solid staple. The PC-12NG is still the most versatile aircraft in existence, and it's still staying way up there in terms of what's been traded and what's been built. The Citation Latitude and Phenom 300 continue their dominance. So they were the fourth and fifth most traded aircraft of 2025. And then the Vision Jet, the G2 Plus. And it's interesting that that aircraft keeps gaining popularity. A lot of it can be tied to Cirrus and their culture that they've created, and the fact that now they've got you from birth until basically you're operating a business aircraft or a jet. And that's very rare. And we're going to talk about later on with the demise of the Bonanza and the Baron. So props to Cirrus for creating a real family of aircraft that a pilot can start with an SR-22 or an SR-20 and then move up to the 22 and then eventually into a G2. I think it's really cool. But the top performers for a new aircraft, that was the Vision Jet, the G2 Plus, the Challenger 3500, the TBM 960, the M700, and the CJ4 Gen 2. And then the worst performing aircraft in terms of new models was the King Air 360ER, the ACJ 220, the Learjet 75, and then the G800, which really shouldn't even be in there because it has such limited data. But early cycle aircraft always move slow. Fleet size, availability, delivery cadence, it'll all play a role. And so what really is going on is that ownership trends have shifted because wholly owned aircraft, they increased from 49.6% to 52%, while fractional aircraft actually went down a little bit. Part 91 operations, they're still continuing to dominate. The top deliveries, so across the board, the Caravans for Part 135, it's the Caravan EX, PC-12s, G700, Global 7500, and for Part 91, the top deliveries were, again, the PC-12 and the Vision Jet G2. Owners are looking for control and predictable direct operating costs. We keep talking about that. Better availability, and they're willing to own it outright to get it. I think a lot of folks that have played the charter game, if you're chartering enough, the one conclusion every one of them will come to is that they got to own their own airplane. So a lot of this makes sense. But here's the big picture. Here's the real conclusion. This isn't a boom market. It's not a bust market. It's what we're going to call a sorting market, because good aircraft are going to continue to sell quickly. Mediocre aircraft are going to continue to drop in price. Unsupported aircraft, they're going to continue to sit. Newer aircraft, they're going to probably go up in value. And mid-age aircraft, the values are going to continue to remain flat or depreciate. And as we've talked about, older aircraft, they kind of hit a bottom and they stay there for, in some cases, decades. I mean, look at the 20 series Lears and the 20 series Falcon Jets. But I think what you're going to continue to see is inventory tighten. And if nothing else, these rate cuts, they're going to revive buyers, because this is one of the most opportunity rich markets we've seen in years, if you understand the data, right? So let's dig into why things are more expensive. After breaking down the performance of each segment, it's important to ask why the market behaves this way. When you step back, one theme rises above everything else. It's just getting more expensive to build and more expensive to maintain and operate and support airplanes. And the resale market is simply reacting. This isn't speculation, it's structural. One of the biggest forces shaping today's aviation market has nothing to do with buyer psychology or short-term demand cycles. It's just the simple reality that the cost of aerospace manufacturing and maintenance has jumped across the board. And every part of the value chain is feeling it. The cost to manufacture aircraft has skyrocketed. OEMs are dealing with historic increases in aluminum and titanium and composites and skilled labor shortages. We've talked about it in the past, and longer and more expensive training pipelines, and avionics and semiconductor constraints. And that's not going away anytime soon. And neither are the supply chain delays that ripple into final assembly. Every vendor in the chain passes an increase to the next until the OEM ultimately adjusts the list pricing upward. And this is why new aircraft prices have risen faster in the last 5 years than in the previous 20. And that's why used aircraft values follow replacement cost economics. This inflation pushes late model and mid-age aircraft upward in value, even during softer cycles. And maintenance costs are rising even faster. And this is part because buyers feel this day to day, because, Parts are just more expensive, and shipping takes longer, and maintenance shops are overloaded, and technicians are commanding premium wages. An inspection that once cost $300,000 for a business jet could easily cost $6. A refurbishment that used to be $1 million is now almost $2 million. And this is why well-maintained turnkey aircraft sell instantly. While aircraft with upcoming inspections and deferred items are sitting or becoming borderline unsellable, the resale market adjusts automatically. When the costs rise, buyers look at the total cost of ownership, not just the acquisition price. At least that's what the smart buyers are doing, because they want predictability, they want supportability, and they want minimal upcoming expenses. That's why an aircraft posting the strongest values today are late model, fully upgraded, fully enrolled on programs, supported by strong OEM ecosystems, and meanwhile, mid-aged models with costly upcoming checks are dropping quick. Older aircraft, surprisingly, they're holding because their direct operating cost for the most part is already known. It's stable. But everything is connected, and the resale market is simply reflecting the new math of aviation. And while rising costs have reshaped resale values, they've also reshaped something else. Who's actually buying the airplanes? And one of the biggest demand engines over the last decade has been the rise of regional charter operators. So let's break that down. If you want to understand the modern aircraft market, look no further than regional Part 135 operators. They are no longer the small, reactive operators of the early 2010s. They've become sophisticated, well-capitalized aviation providers, and they're buying aircraft at a rate we haven't seen before. And, 10 years ago, regional 135 operators, they controlled about 1,800 aircraft nationwide. And today, that number exceeds 3,500. And depending on how you count managed fleets, that's a 75 to 90% growth in a single decade. Many operators who once purchased a replacement aircraft every 3 to 5 years now buy one, every year, sometimes multiples in a year, because they have to support guaranteed lift contracts and corporate shuttles and medical and emergency support and regional high-frequency routes. And this is the institutional buying power, something that the used jet and turboprop market wasn't built for historically. If you're tired of guessing aircraft values, try VREF Online. It's real-time data, quarterly updates on over 900 models at your fingertips. From residual value forecasts to depreciation trends, it's the platform trusted by lenders, insurance companies, and professionals worldwide. Subscribe today at vref.com and start making decisions based on facts, not feelings. So why the surge? Because corporate clients want reliability, not membership programs. Companies are tired of rolling the dice on fractional availability. They want guaranteed lift and predictable costs and local service. Modern turboprops and light jets change the economics. The PC-12, the King Airs, Phenom 300s, the Vision Jet. These fleets are cheaper to run and more reliable than the legacy fleets of 10 and 20 years ago. And technology professionalized small operators, automated quoting systems, scheduling systems, predictive maintenance. It all allows regional operators to act like the national brands. And so a decade ago, Part 135 operators represented 10 to 12% of used aircraft purchases. Today, that number is 30%. And the demand is in many categories, especially turboprops and light jets. And that's what's stabilizing those values, because they're absorbing the inventory and they're reshaping how OEM production prioritizes things. And they're becoming the most predictable buyers in the market. But none of this happens in a vacuum. Rising costs and growing regional fleets collide with the last major force shaping aviation, and that's the cost and availability of capital, which brings us to the last piece of the 2026 outlook. Inflation, interest rates, commercial capital. What does aircraft financing look like as we head into 2026? Well, heading into 2026, the biggest wild card is still capital. How much it costs, who can get it, and what lenders are willing to finance. We're entering a period where interest rates are easing, but not fast enough to return to 2020 pricing. Inflation is cooling, but it's still very sticky, and lenders have not forgotten the defaults and the restructurings. And, inflation, while it's down, even with modern inflation, aviation still faces elevated costs. And we talk about this, how labor and insurance and training and hangar space and maintenance and parts, all of this stuff continues to go higher. And so underwriters model these pressures into financing assumptions. High operational inflation, higher portfolio risk, right? Higher risk equals higher terms. But the Fed has begun cutting rates, and while it's cautious, I think 2026 will bring modestly lower interest rates, improve borrower affordability, but still significantly higher interest rates than pre-pandemic levels. And while buyers are expecting 3 to 4% loans, I think they're going to be disappointed because I don't think we're moving towards stable, rational pricing anytime soon, at least not cheap capital. Banks, private lenders, and non-bank institutions are dipping back into aviation, but with strict guidelines. And they prefer younger airplanes, certainly anything that's, younger than 10 years. And they want stuff that's supported. And they want to deal with Part 91 borrowers with strong financials who don't have to rely on chartering their aircraft out to make a payment. And they want aircraft with predictable direct operating costs. And they want those aircraft enrolled on programs. And they're going to avoid old airplanes that aren't supported, that have maintenance expenses through the roof, right? Or anything with an uncertain residual value. So I think 2026 is going to be the year of predictability because rates are going to continue to come down and capital, it's going to continue to return, but underwriting is going to continue to tighten. And I think that's going to help stabilize the market. In 2026, financing won't be cheap, but it will be available. And in aviation, steady financing being made available is often the best case scenario. So that wraps up episode 14 of our podcast. For full valuations, historical data, any pricing, visit VREF.com. Until next time, I'm Jason Zilberbrand. This is The Truth About the Market. Fly safe and stay smart.